Hi, everyone. Thanks so much for joining on what's been a really interesting week and the last full trading week of the third quarter of 2025. Where has the year gone? But let's dive straight into the charts so that we can see exactly what's going on now. As you can probably recognize, my favorite chart to start with is the World Equity Index chart on Bloomberg. Now, if you follow my pointer, we are just going to look at the percentage change of global indices. Obviously, US indices are out. They're not open yet as of this time of this recording. So we're looking at European indices. They are a sea of green. Now, if we go up to the US indices, we can see that on Thursday, US indices were closed lower. And then if we actually move over to the 5-day change, we can see Euro stocks and the FTSE 100 poised to eke out a very small gain for this week, if all things remain the way that they are until the end of Friday. We've got losses for the CAC, very small losses for the DAX and for the IBEX there in Spain as well. But all in all, a very muted week with gains hard to come by. Likewise, if we look just higher here where my pointer is, you can see that US stocks are actually poised to record a lower week. Now that's if we don't see a big increase in shares this Friday. If we don't, then stocks will close lower for the first time in September. Now I want you to remember back 4 weeks ago, I know it seems like forever ago, but back then we were talking about seasonality. Seasonality in stock markets happens in September because September is typically a weak month for US stocks. So I think in over the last 4 years, only 1 year has seen a positive gain in September. That was last year for US stocks. But actually, this month has been fairly good for US stocks. If I show you month-to-date performance, for US stocks, well, for global stocks, as you can see, an absolute sea of green. So we're just tapering off as we get to the end of September, and that's something worth noting. Now, the other thing I wanted to show you was bond yields. I want to show you bond yields because they have been moving around quite a bit. UK yields and European yields are lower. Now, US treasury markets are open. So we've seen kind of hardly any movement really in treasury yields so far today. This is the 10-year yield. We're seeing a bit of a pullback in UK yields and European yields generally. And if we just go to the 2-year yield, as you can see, yeah, a bit of a pullback in Europe, but nothing major. Yesterday, we saw a really big recalibration of yields in the UK. So yields rose across the curve. The 10-year yield rose 8 basis points. That was on fears that Keir Starmer would be toppled from his position as Prime Minister and would be in replaced by Andy Burnham, who is a left-leaning politician. So that really spooked the bond market because Andy Burnham has said in recent interviews that he's not going to bother about the bond market. He doesn't care. He wants to borrow more, regardless what the bond market does. Now, anyone that even a basic grasp of economics could see that wouldn't be a very good idea. That when you have a budget deficit like the UK does, you really do need to be worried about the bond market. So the bond vigilantes, they woke up. But it seems like that push higher in yields has actually ended Andy Burnham's threat to topple Keir Starmer. So Keir Starmer, along with Rachel Reeves, have actually been saved by the bond market. So there's one thing for the UK gilt market right there. But as you can see, not too much going on, but I do want to show you what's been going on in the past month. So in the past month, bond yields, they haven't really moved too much, but I'm looking at the 2-year because that's what's most closely linked to where interest rates are going. So we've seen a bit of a decline in US yields and a big increase in, a fairly 3 basis points, not a big increase actually, but an increase in European yields. If we go to 3 months though, big recalibration, bigger decline in US yields, bigger increase in UK and European yields. But if we just look in the past week, that's something to note. Actually, there's been a bigger increase in US yields compared to European yields. Now, that's important because we had some really strong GDP data out of the US yesterday. That showed that second quarter GDP, it was revised higher, growing at a fantastic rate, led by the consumer, but also signs that investment is still very strong, and investment was strong as we moved into Q3 as well, because we had some really good durable goods numbers for August as well. So Let's move on to the economic calendar for today. It's been fairly quiet economic data week, but there's a lot of economic data coming out of the US later this afternoon. That includes the PCE price index. So PCE is closely watched because it's the Fed's preferred inflation measure. That is the PCE core index. Sorry, just bear with me, guys. The PCE core index is expected to come in at 2.9%, so to remain stable. Now that is well above the 2% Fed target inflation rate. So essentially, what today's data could show is that inflation is running hot in the US at the same time as the economy is doing really well. Now, this data goes back to August, so it's seen as being a little bit out of date. But look what comes up later today at 3 o'clock London time. We get the University of Michigan sentiment readings. They're expected to remain fairly stable for September, but it's the inflation forecasts that I think are actually more important. 1 year inflation, the University of Michigan 1 year inflation forecast is looking for 4.8%. 3.9% for 5 to 10 year inflation. That is well above the Fed's target rate. So we're looking at some hot inflation. Now that could reduce the likelihood of Fed rate cuts. Now there have been two things that propped up the September rally in US stocks and global stocks, really. Prospect of lots of Fed rate cuts and also the AI boom. As this rate cut expectation has been peeled back, now it's not been peeled back by too much, but if we just have a quick look at the work chart, so this is world interest rate expectations for the US. As you can see here, we are expecting through to the kind of mid-2026 for there to be just 3 rate cuts. Now, if I go back to the start of this month, we'll see how this has changed. The start of this month by a year ago, yeah, so there you go, it was 5.25, so over 5 rate cuts were expected. So we've now pared back about 50 basis points of rate cuts since that Fed meeting. So that is having a big impact on stock markets, particularly in recent days, and that really is having an impact. Now, if we just look at the Magnificent Seven, because obviously they've really been powering US stocks. In fact, tech generally has. As you can see here, Apple, so this is just the last 3 days. So it's just what's been going on pretty much this week. So we haven't seen a big sell-off in stocks at all. If I even go for the past month, we just zoom out a little bit in this chart. Just bear with me because there's a lot going on in this chart. As you can see, we haven't really gone down very much, but we've gone sideways for most of that Magnificent Seven. So it does suggest that these rate cut recalibrations are having a big impact on these big tech stocks, and they're the ones that are driving things forward. Now, as you can see, over the past month, Tesla has done very, very well. Now that's tapering back a little bit. So has Google. Google got rid of its lawsuit in the US, so that's really helped it as well. It also became the world's 3rd largest company, got over a $3 trillion valuation. We've also got Apple. Apple has done very, very well as well. So if we look there, sorry, Google is the 4th largest company in the world, not the 3rd. I do apologize. Apple as well has done very, very well. So Apple is on the up. Everything else, though, is moving sideways. So that does suggest that these Magnificent Seven tech stocks and tech in general is linked to what's going on in the bond market, in the interest rate futures market. So we do need to watch that when we're talking about them, because they are 2 pillars of equity market strength. Now, some of you may have been around in 2008, when there was the global financial crisis. Back then, there was a guy called David Einhorn. You might not remember him, but when David Einhorn speaks, the market listens. And David Einhorn has spoken now. Now, he spoke back in 2008. He was really the short seller and the guy that uncovered a lot of the subprime mortgage scandals, and that brought down Lehman Brothers, that brought down RBS. He'd really uncovered it for what it was, that it was a complete kind of sham, and huge defaults were coming. He said that. He saw that first, and he was very public with that. Well, now he's sounding a warning about AI and saying that there's going to be a lot of capital wasted. So if you look at the Googles of the world, the Microsofts, the Meta, they are spending trillions of dollars on AI infrastructure. And he's just giving a bit of warning about that, saying that he thinks that some of that capital will be destroyed if AI does not deliver the goods. Now, I'm not saying that what David Einhorn will say will come true, or that it will have a massive impact on stocks right now. There have been some moderate losses for the big tech stocks this week. And there's no sign in the pre-market that they're going to fall off a cliff or anything. But it does mean that the Q3 earnings season, which will start start from October, from about the middle of October, lasting through to the end of November. That will be absolutely vital for these big tech stocks, because obviously if their investments aren't paying off, I think there's going to be a closer eye on those investments and how they are impacting business and impacting revenues and forward revenues as well. So that's just a risk factor coming up. If we just take a quick look, lastly, at the currency market as well, this is currencies, the US dollar against the G10 counterparts over the past week. As you can see, the dollar is gaining against its G10, so it's the strongest currency in the G10 in the past week, but not on Friday. We've seen a little bit of a weakening, which suggests that maybe risk will kind of just drift into the end of the week. But overall, if we just go back to that equity market page, as you can see, we are just starting to press a little bit of pause. Nothing too major is driving that, but there are concerns about Fed rate cuts and that there won't be as many as expected, and also some very mild concerns about AI and these big numbers that are being thrown around. So maybe it's just time to take pause, and it won't actually be September that's a rough month for stocks, even though seasonally that is. Maybe it'll be October, but we will speak again soon. Thank you.